Good afternoon, everyone. We'll just wait for a few more seconds for everyone to come in. Definitely, I want to thank you all for attending today's webinar. Should you have any questions throughout the presentation, I strongly encourage you to put them in the Q&A. The easy questions, send them to me. Any hard questions, Jose Monte, he'll be more than happy to answer them on your behalf at the Q&A section. Also, this is a good opportunity for you to network, get to know everyone that's in today's presentation. What type of business you have or planning to have a business. Also, for the interactions, what are some challenges that you're experiencing based on your financial capacity? Have you trying to get loans or micro loans? What type of inquiries that you are trying to obtain? So like that, at the conclusion of today's presentation, strongly encourage you to register to meet with our business consultants, meet with Jose, and he'll be able to assist you with your business needs as well. So it's a good opportunity for you to meet Jose and the rest of our Navigator program. So once again, thank you for attending today's webinar. This is a recorded webinar, so all participants will be receiving today's presentation. So strongly encourage you to like and subscribe at our YouTube channel, as well as in case if you have to step out, answer a phone call, you'll be able to do a playback of today's webinar at a YouTube channel. So definitely encourage you to like and subscribe. Also, we have a plethora of a library of previous webinars that we have done. So it definitely enhances the conversation while you're meeting with our Business Navigator team. Okay, so we're going to go ahead and get started. So today's webinar is what your lenders need you to know. So we're going to give you some of the tips and tricks once you're able to have that meeting with the respective lenders. So like that, I'm giving you the homework before the teacher gives it to you. So this is a good opportunity for you to enhance the conversation while you're meeting with the lenders. So like that, you will have a good success rate in obtaining the necessary funds by following these processes as well. So before I continue, allow me to introduce myself. My name is Jesus Padilla. I am the Manager of Administrative Services here at the Florida SBDC at FIU under the FIU College of Business. And it's a great pleasure to have Jose Monte. He is our business consultant in the realm of access capital under the Miami-Dade Business Navigator program. So Jose, do you want to introduce yourself and from your background and experience?
Thank you, Jesus, and welcome everyone. I've been a sort of retired now, but I was a commercial lender for the last 30 years, specializing in small business with this commercial lending, industrial, and commercial real estate as well. So I've seen and done it all in the last 30 years. So I can tell you pretty much what the lender needs to see, what you need to produce, and know about your business in order to kind of improve your chances to get that lender comfortable and consider your loan request.
Okay, perfect. All right. So a brief description of what is the Miami-Dade Business Navigator program is funded through a cooperative agreement through the Small Business Administration. It was established in part of the American Rescue Plan Act of 2021 to help you, the small business owners, in the economic recovery and resiliency. Overall, the program is comprised as a lead hub. In this case, it is the Florida SBDC at FIU, along working with a center of spoke organizations that deploy community advocates in the community. This program is focused on business owned by veterans, women, as well as socially and economically disadvantaged individuals. Along with the Florida SBDC at FIU, we also have 6 other organizations to assist you as well. We have Ascendis, branches, the EDC of South Miami-Dade, the Miami-Dade Chamber of Commerce, Prospera, and SARPA FIU Procurement. All of these 7 organizations are able to assist you at no cost to you if you're looking for access to capital, the microloans, there we go. I got a shout out. De La Prospera. There you go. Branches, in case if you're able to increase and improve your credit to obtain necessary capital that's seeking, they'll be more than happy to assist you on that side as well. The EDC of South Miami-Dade, if you're looking to do business over the south part of the county. It's a good opportunity for you to know what local initiatives are out there. The Miami-Dade Chamber of Commerce has a lot of trainings, networking opportunities to all small business owners. Prospera as assists with business owners that are Hispanics, but at the same time provide additional technical assistance in all different facets of what small business entails. Cyber Fire Procurement assists you with business owners to get ready for the solicitation, the contracting, the bidding process, the estimation to obtain the necessary local contracts and state and federal contracts in your business venture. We have Ascendus, last but not least. There are CDFI that assist with microloans to assist you to have the capital infusion to start your business, but also to grow your business for the next phase of your of your um, of your goals. And last but not least, the Florida SBDC at FIU. We have specialized consultants to assist you at no cost. Once again, all of these services is no cost to you in all different facets as well of what a small business entails. If it's starting a business, business planning, marketing, operations, strategic management, financial forensic analysis. All of our services confidential once again, and are able to assist you all under one umbrella with these 7 organizations. So once again, if your business is located outside of I would say the Quad County region, which is Palm Beach, Broward, Miami-Dade, Monroe County, we're more than happy to assist you. If you're located outside of that jurisdiction, by all means, strongly encourage you to send me an email, and I'll be more than happy to connect you with your respected local resource partner. But this program is intended for the businesses that are physically located here in Miami-Dade County, with a focus on the 3 key pillars, which is consulting, mentoring, and training, as such you're in today. Perfect. Okay. Yes. If your business is located in Hillsborough County, my recommendation is to send me an email in the chat, and we could definitely schedule a meeting, and I could connect you virtually to my colleague over at the Hillsborough County, by the Florida SBC at USF. Okay. So like I said, if there's any questions, or do you want us to elaborate more on the slides, by all means, this is for you. We're here to assist you, but like I said, the easy questions to me, the hard ones to Jose. Okay. So once again, this is a great opportunity for you to connect with us on our social media channels, at LinkedIn, Twitter, Facebook, Instagram. Also, the YouTube channel. Strongly encourage you to once again like and subscribe, so that you're able to get today's presentation recording, but also the previous presentations that we have done in the past year or two. Okay. So, like I said, thank you all for attending today's presentation of what your lenders need you to know. So, start off, you have to have a clear understanding as to who is in your team, besides your respected employees, but who else? Who are the external players? It could be a CPA, it could be an accountant, your banker, the insurance agent, any vendors that you have, any financial advisors. Who is in your team that definitely know the numbers, the books of your business? So by having a clear understanding of your numbers, like that, you're able to have that conversation, have the same language or the lingo terminologies while you're having a regular conversation with a respected banker or a lender. So for example, if you have a conversation and someone asks you what are your numbers, you're not gonna be picking numbers around the thin air. You want to be confident with your responses. Jose, from your experience, when clients they don't know their numbers or have that dialect, what has been some best practices that you've been able to teach them?
Yeah, and when we're talking about a small business here, and from a banker standpoint, you have to know your numbers. You cannot walk in and to meet with a lender and not know what the business is doing, what it did last year, what you're doing this year during the first 6 months, what you think it will do next year. So you've got to have your financials, whether it's your bookkeeper. Maybe you're small enough that you don't have a CPA, but you have a bookkeeper. And a lot of times, small businesses, I mean, you're doing a P&L monthly. So again, there's no reason, you have to know your numbers. You cannot have a discussion and not know what you sold last month, last week. You're at a small business. On a larger scale, that's different. You may have a CPA in-house, you may have a CPA outsourced, and you're using different kinds of audited financials and audits and what have you. But in a small business, it's very important that you know your numbers, you understand who your clients are, who your vendors are, how much your markup per product is, because these are questions that a lender may ask you to sort of remember. You understand your business, the lender does not. So you need to make him comfortable to understand that your business is one that's viable and you have a very good handle on it. And you're able to weather any storm or product, all of a sudden you have a supply chain issue, you have a backup plan. You have a different product that you're selling in a different store, depending on what your business is. But you've got to know your numbers. And typically, it's your bookkeeper. In a small business, a lot of times the owner is the bookkeeper. He may have Quicken, he may have software. So typically a small business, you have to know your numbers. Otherwise, it makes it very difficult to get a lender comfortable.
And Jose, for you, what's the most important number? What's important in the numbers? Any matter to income, expenses, investments? What's an attractive number?
Well, there's in a general sense, there's two key elements. When you're talking about getting capital, when this is a capital discussion, one, revenues that you're selling. You have to have that your product is you're successful. Whatever product or services you're offering, you have a market, so you're selling. Now, the biggest one is profit. What's the bottom line? I mean, I'll give you an example. If you're buying a pair of shoes at $5 and you're selling it for $4.50, and you're selling $1 million worth of shoes, you're losing money. So a lender says, well, you've got a market, but something in your business is wrong. You're either buying too expensive, you're undercutting maybe your competitors too much, and you're not making money. So you've got to have sales, but you've got to make money. Now, a good lender, if you're paying yourself, I know we don't like to pay taxes, so we like to basically throw everything but the kitchen sink in, depreciation, interest. We like to pay ourselves a good salary. So in other words, so at the end of the day, you make very little money. Now that's good and bad. Good because obviously you're making the money, not paying taxes. A lender says, well, but you're not making money. So I have to go what's in black and white. Now, some lenders, if you're overpaying for what an industry norm is, they can back in some of the income to help you for repayment when you're looking for a loan. It just depends on the loan size, how much you're repaying yourself, what the expenses are. I mean, obviously, people, businesses like to increase the expenses because it limits their tax liability. But again, you've got to have some sales. It's a cliche. The more you sell, the more profits you have, the easier the discussion is to raise capital, to talk financing with a lender.
Okay. Well, and I have a question. And by doing so, this is where you have to start having a fully understanding of the 5 C's of credit. And let me see if I have another question right here. Okay. So in this case right here, pretty much it was a growth start with 120, and then in 1 year have over $100,000 worth of inventory. It's a banquet hall. But then after 2 years with success and the owner want the building back. So pretty much it's like almost like a leasehold capacity, right, Jose?
I'm sorry. What was the question again?
It's in the chat. It's in Q&A. So pretty much it started off with $100,000 worth of inventory. It's in the banquet hall with nothing to secure. Well, it was successful, but then after 2 years with COVID, the owner of the building wanted it back.
Okay, so he was leasing.
Yes,
He was leasing the building. Okay, but I don't see. Okay, but what's the? I'm sorry. What was the question?
It was in their case in regards of the team and getting the necessary funds.
But where's the question? I can't find it here on my
Q&A.
Okay, I'm sorry.
Okay. So in the time being, as Jose is looking at Q&A, I will go ahead and proceed with the character. It is who you are. What have you done in the past that makes you qualified to start up the business or to continue expanding your business? It talks about your credit score, your reputation, your experience. Have you been able to repay back your debts in a timely basis? Also, it could be what other debts you have. It could be student loans. It could be um, other business loans, equipment loans. By having a good understanding of your credit, how you have handled the previous debt obligations, shows your withstanding that lenders could definitely um, provide you the necessary funds that you need. The capacity is the ability to repay back the loan. For example, if you're generating a business of $10,000 and you're seeking funds for $1 million, that is where it's a big risk because the lenders, they might not want to lend you that amount of money because you won't have the capacity to repay them back. Jose, from your experience in terms of the capacity rate, what is a good sweet spot of a number that clients could definitely look at when seeking the necessary funds in terms of the debt service coverage ratio?
Yeah, I mean, I can tell you that the standard debt service coverage ratio pretty much across, if we're talking in real estate terms, it's usually 1.25 these days. When you're talking asset financing like receivables, inventory, or what have you, there's no tangible collateral like real estate. It could be much higher. It's 1.5. So typically, in other words, for every dollar of debt that you have, that you need to see $1.50 of available cash flow, and that's the margin to make sure that should anything hit the business, any slowdown, there's enough margin for you to continue to meet your debt obligations, the loan obligations. So obviously, this goes to this is the biggest factor, is the capacity. You have to have the capacity to repay, and you've got to have excess cash flow. You can't walk in and break even and say, I'm looking for a loan, because the lender's going to say, well, how do you plan on repaying me? And again, these are not grants, these are not charities. They lend the money out, they get it repaid, they lend it back out again. Now, the key thing is, once you get a loan and you're repaying that loan, that gives you sort of leverage to increase the loan down the road. Because obviously you're already in the door, you've already got a loan, you're servicing it. And that's what helps you to perhaps increase the loan if the business is increasing. So once you get a banking relationship, the banker doesn't want to give you the loan and get it repaid and on to the next one. A banker wants to grow with you. You may start today with a $100,000 loan. He would like to give you $500,000 and keep growing with you, because they're in the business of lending money. But it has to make sense. You've got to have the numbers again, and again, this is what's going to focus on your tax returns. On small businesses, they will not focus so much on financial statements, because the smaller businesses are less sophisticated. They're more costly to have an accountant in-house, and they know that. So they'll go basically on what you file. Would you tell Uncle Sam? That's going to be the Bible for them to look at your numbers and get comfortable with your loan request.
And then, is there any choice that I can get a real estate loan with no big down payment? I continue to offer the banquet hall services, but with other venues, it is so hard.
Well, if you're talking about acquiring a property, yes. I mean, the traditional sources of going to a bank or a credit union will not be your factor, because they're going to require anybody anywhere from 25, 35, 40% down payment on the property acquisition. We're talking about buying a property. Now, the SBA has a program called the 504, where the down payment or equity requirement is 10%. And the way it works is, and the SBA is really not a lender. The SBA programs, the 504, those are handled through banks. And almost every bank in town that has an SBA loan officer or lending department. So you walk in, you talk to the loan officer. I'm looking for an SBA 504. I want to buy my warehouse. I want to buy my condo, my commercial condo, my industrial warehouse, my location, whatever it may be. And under the SBA 504, the way it works is a 90% loan. The bank would fund 90% of the loan. You put in 10%. Now the SBA, 6 months down the road, pays the bank down 40%. And they stay in a second position. So the way it works out is you have your bank with a 50% loan exposure, the SBA with a 40% loan exposure in a second mortgage position, and you've put in your 10% equity. And that's an SBA loan. And those are long-term fixed rate loans. Those are commercial loans, 10-year fixed rates, and 20 or 30-year terms. So it's very attractive. It's very attractive because you put the minimum down payment. Now, again, the SBA, you're applying through a bank, and your bank handles the process. So you've got to give them 3 years of tax returns, personal financial statements, personal tax returns, banking statements. So it's a loan, and you'll go through the normal due diligence process of a bank, which is, it's a process. It's a process, and it's lengthy. And they will scrutinize to make sure that you obviously can repay.
Is it just 10% or is there additional costs as well?
No, 10%, and there's loan fees that are involved for the SBA and to the lender, and those are standard loan fees. Any lender can break that down for you depending on the loan amounts and what have you. But no, your cost is your equity cost is your 10%. On $1 million building, to use a big large round number, you're talking 100,000 is your equity. 100,000 will come from the lender and from the SBA.
And then this will come into the play based on the capital side, based on what's the equity at hand for the project, the down payments that you have, along with the percentages, pretty much like all the key ingredients of the necessary capital. While doing so, it parlays with the collateral. What is the assets that the lender will be accepting as a security for that loan? So in case if you don't repay back that loan, what is the bank going to be getting back as the insurance? It could be the mortgage of the house, it could be the car, it could be any assets that the business has. Jose, from your experience, what's one of the best ways to get the collateral or provide the collateral?
Obviously, we're in South Florida, and lenders love real estate. That's a no-brainer. But small businesses sometimes don't own real estate, don't have the real estate. Now, I know a lot of lenders sometimes will ask you, well, can we put a mortgage behind your residence? And that's something you need to really be very careful with. If this is a startup business and you don't know where it may lead, you'd be very careful with putting your residential property on the line for a business venture. So you've got to be careful. Aside from real estate, obviously, if you've got inventory, if you're selling products and you have receivables, obviously they'll take an assignment, the UCC filing. It's an assignment of your rents and leases, inventory, and receivables. What that means is if you stop paying them, the lender can step in and say, hey, instead of paying Jesus what you owe him, you pay it to me. You pay it to the lender. So that's what that assignment allows them to do in the event of non-payment or a default. Now, keep in mind from a small business standpoint, if your business has been around for a number of years, and it's profitable, you're making a living off the business and it's functioning well, there is a source of capital out there. But again, you've got to weigh it where it makes sense, and that's the home equity line of business. If you own your home, and you have equity in your home, you can tap that equity and get a line of credit and use it towards your business. It's good because it works almost like a credit card. You only pay if you've drawn on it. It's usually very low. It's usually very low interest, lower than you can get for a commercial loan, because obviously it's got residential property. It's like a credit card. You draw on it, you pay it back. It's like a credit card. This month you drew 10,000, you paid it back when your receivables came in. You owe zero, and you only pay on whatever you owe. It's usually a 10-year revolving line. But again, if you're fairly confident in your business, and it's succeeding and it's going, and you have no worries about it, it is a source of capital that is economical. But again, you've got to be careful because it is your primary residence that you're putting as collateral for your business. So you've got to be very careful with that. And also something also. So remember, these are traditional lending sources that will require this sort of collateral. There are other lending sources Jesus can provide you with. There's a lot of micro lenders, there's a lot of community lending organizations that are willing to lend smaller amounts unsecured. In other words, they won't take they won't take a car accounts receivable, and they'll base it on typically that you've got revenues coming in. A lot of times they might not even use tax returns. You could be a fairly new startup, but you're selling. You're a 6-month startup, but you do have revenues. So what happens is they'll ask you for, well, give me your last 3 months bank statements, and based on that, they can approve you for a small business loan. These are not banks now; these are micro lenders. You know, the issue with banks is banks are highly regulated, and when you're regulated, you've got to follow certain protocols to underwrite loans. You can't just decide, well, he's got pretty good months of sales, and I can lend him money. No, they have a different credit policy that's very detailed, and underwrites the credit risk of the loan. Micro lenders are a little different. They can make more judgment calls just based on it's a 6-month startup, but he's selling, and based on those average sales for the last 3 months, they can lend you a small business loan to maybe gain some more traction. So there's many different types of lenders that have different requirements. Some require very excellent credit. Some do not require so much on credit, but they require that you have monthly revenues coming in, and they verify that with bank statements.
And on top of that, the best alternative is to see which is the best microloan is best suited for you, or from which CDFI is available for you. So I encourage you to register to meet with Jose, so that it's a good self-assessment as to which one is best suited for your business needs. So that is my recommendation as a key takeaway, that there's a plethora of CDFIs, lenders that are out there, but which one is best for you, because it's also based on what industry you're in. So by having the Goldilocks approach, working with Jose will be beneficial on the long run for your business needs and decisions. But then at the same time, what's the overall usage of those funds, the capital infusion? What do you intend to use these funds for? Is it working capital, hiring people, buying the inventory, or the machineries? What is the end goal? And at the same time, what is the term of the loan? Is it going to be a 30-year fixed rate of this percent interest rate, or it could be a 48 months at 10%? So by working with Jose, he'll be able to guide you based on which is best alternative with those funds, with the new projections of the infusion. So for multiple reasons. One, to generate sales based on the small loans that you'll be obtaining, but at the same time, repaying back the respective lender, so that when the time is right, it shows that you have the character that you're able to repay back those loans, so that you're able to obtain higher amounts of capital down the road. Jose, do you have any comments?
Yeah, I mean, and I'll give you sort of I guess a general comment. When you talk to a lender, in general, and I hear this sometimes from different clients. You can't go to a lender and tell them, here are my financials, how much can I get? That's a no-no. When you walk to a lender, you need to know, I need 20,000, I need 30,000, I need 100,000, and there's got to be support behind it. This is why I need 100,000, not because, hey, I want to grow. We all want to grow, but there's got to be a need. There's going to be a basis for why you need 100,000 or 20,000. It's got to be broken down. I need to buy. Right now, I'm outsourcing X amount of work to contractors for machinery. I'm making a product and I'm outsourcing X amount. I want to now make it in-house. Instead of contracting, I want to buy the machine. Instead of outsourcing, I want to be the one to control it in-house and produce my product. So you've got, and that machine costs X amount of money. It costs 20,000. I've got 5,000. I'm looking for 15,000. There's got to be a methodology to why you need the money. And by doing that, instead of paying so much to outsourcing to this contractor, it now costs me less. I'm paying the monthly just for the machine, for the financing, but I can make it at my pace. I can make more product. I can make it cheaper and sell at the same margin and make more money. So those are the answers a lender wants to hear, not just I need 100,000. No, well, how is 100,000 going to change your business? And you need to have a good answer
I
for
think
it.
Jose froze.
And that sometimes that ties in if you have projections. That's helpful. Look, this is what I'm doing now. This is how the increase allows me to sell more, generate more. So a lot of times those things help in the discussion. You need to know exactly what the money's for, the purpose. You can't just tell them I need 20,000. You've got I need X amount of dollars for here, for this, for that, and it totals so much. And this is what I need to get the business to the next step, to continue growing, to expand to maybe two locations, to more product lines, depending what it is. But you've got to have good answers.
Yep. No, and at the same time, oftentimes from our experience is that one is looking, it's like I need $50,000 from my marketing budget. But then at the same time, working with Jose, it's like, you know what, based on the capacity and so forth, the best that you're able to obtain is 25,000. So now how you're able to pivot and start working towards that amount. But then at the other side of the token, it's having a good estimation and having concrete earmarks of those funds, as I need this amount for this amount for that, is able to help you out. Because oftentimes you say, I need 50,000 for marketing, but working with a marketing consultant, like, actually, if you want to implement all of this, it's going to cost you $150,000. So there's a whole different landscape, a whole different monster that you're going to start tackling at that moment.
Yeah, and a lot of times lenders, if you really need 100,000 for a specific need, that's really what you need for the business to accomplish certain objectives. And you go, but I'll take 25,000. The lender says, well, 25,000 is debt that you're going to take on, but it's not going to get you where you want to be. So why am I going to give you 25,000 when I'm not getting the job done? So the numbers have to make sense. What you need it for. And again, Jesus mentioned, there's consultants here that can help you. And perhaps they may tell you the cost is much less. We can do certain web designs and strategies, and mass media that you can reach the same target market, for a fraction of the cost. It's a matter about knowing, how to get things done.
Yes, and then once again, I've been getting a lot of inquiries. This is a recorded webinar, so all participants will be receiving the link from our YouTube channel and also today's presentation as well. And then at the same time, this is where you're able to have a good understanding of your credit score. If you have a very low credit looking for funds, most likely you will be denied. But don't worry, because we have organizations under the Navigator program that can assist you to improve your credit score. Often, if you have a decent credit, obviously it's always good to improve it because it's better rates. But if you have not a fair credit score, obviously it'll be a smaller loan, but with a higher interest. So having that Goldilocks approach is best suited for you to obtain the necessary funds with the rates within your capacity. Jose, do you have any comments or inquiries?
Yeah, I mean, this is the FICO. This is the FICO rainbow that shows the standard credit score rating. Obviously, we know that COVID put a dent in a lot of credit scores worldwide, and lenders know that. And sometimes certain things in credit can be explained. Some certain things can be explained. And as I just mentioned, there's lenders for all credit scores. There's a lot of micro lenders that, again, don't focus on the credit score. They focus on what is the business's revenue. So it depends. There's many different lenders that have different approaches. The traditional lenders, such as banks, they go more along this because this is sort of the standard criteria for underwriting. Now, keep in mind, from a credit score standpoint, if you have bad credit, but the business is doing decent, the lender's perspective is, well, obviously you're not handling your personal situation, your personal credit, your personal responsibilities well. So they tend to think that will translate into the business. So if you're not handling yourself personally well, chances are the business eventually may not be handled well either. So that's why your personal credit score of the owner is a mirror of what they think how the business is run. So having decent credit score. You don't have to have excellent, but having a decent credit is very important when it comes to the small business lending market. It's looked at closely regarding banks. Outside of banks, it's a factor. The bigger factor are that obviously the business is generating revenues and sales and has repayment. Those are the biggest factors outside of the traditional lending sources, which are banks.
So then right here, it's once you have a full understanding of the 5 C's, now these are various loan types that you could definitely apply for the respective loans. It could be the real estate loans, purchasing a warehouse. At the same time, a line of credit is always good in case if, for example, you're in the government contracting side, that you need to have a line of credit so you could withstand your respective cash flows when the agency pays you for your hard work. At the same time, a term loan, as we discussed, it could be 30 years, it could be a small infusion, like a small bridge loan, and also a leasehold improvement. Jose, do you want to elaborate a little bit more of these 4 types of loans?
Yeah, I mean the real estate loan, as it states, I mean you're acquiring property, you're acquiring your condo warehouse, your industrial condo unit, you're buying your premises where the business is operating. And that's a long-term fixed loan, and it's well secured. And obviously those that would fall under the SBA 504 if obviously you're an SBA candidate for that kind of loan. Line of credit is what we call the working capital. Is working capital line of credit. You draw on it, you pay interest, and that's supposed to be revolving. So that's the key word in line of credit, is revolving. I mean, if you start drawing from the line of credit and you're not constantly paying it back on a monthly basis, it becomes permanent credit. And obviously that's not what lenders want to see. So when you have a line of credit, they want to see that the line of credit fluctuates up and down. You draw on it this month to buy materials. You build the materials, you sell them. When the payments come in, the receivables, you pay the line down. Anything excess, that's cash flow, that's profit for the month, etc. Next month, you do it again. You draw on it again, you sell your product, you pay it down. And you pay interest only, and that's usually floating interest. So the interest floats because it's a revolving kind of a product. Leasehold improvement, I'll give you an example. You own a restaurant, you own a fast food or a kitchen, and all of a sudden you want to update the equipment. What you have is it's breaking down, it's not working, or what have you, or your machinery. So that's called leasehold improvements. And that's what you're improving your business facility, whether it be a kitchen, whether it be machinery, whether it be the office setup. And that's leasehold improvements. And again, that's typically a term loan because, again, it's a long-term product. It's a long-term financing for the business. And a term loan, as I said, is a term loan. It could be 3 years, 5 years, 10 years. It depends. And this would be, if you're talking an SBA sort of a 7A program, which is a term loan without real estate. It would be a term loan, and again, that's monthly payments fixed of P&I. The good thing with the good thing with a term loan is you know what your payments are monthly. You know what your cash flow has to be to cover those loan payments. So you can do it helps you with budgeting. Okay, I know I've got to continue certain sales growth or certain profits to continue to meet my monthly debt obligations on a term loan. And those are pretty much the 4 loan products that are out there. And again, obviously you have unsecured. The leasehold improvements, they may take a UCC on the machinery, on the equipment. And again, these are your traditional loan products. And you have other ones that are your non-traditional, your micro lending, your community lending organizations, your CDFIs. They have a lot of times it could be unsecured because again they're not regulated industries, so they're allowed to do unsecured loans. In essence, they're those scrutinize you less than a traditional lender, but the loan amounts are also less. They're talking smaller loan amounts, and the rates will vary. The rates will vary depending on obviously on credit, on the amounts, on the terms. The credit will fluctuate.
And then at the same time, for the SBA lending, like the SBA backed loans, these are what you as a borrower or slash company would need to be providing. The last 3 years tax returns, the financial statements, the business plan, the entities documents, like if it's an LLC, corporation, what is pretty much your plans, the specifics, what's the budget, the equipment listings of any assets. Jose, can you elaborate a little bit more of the SBA lending and like what is the SBA backed loans?
Yeah, and again, this SBA lending, but this is SBA slash traditional bank loan. You walk into a bank, whether it's Bank of America, you're talking TD Bank, Chase, U.S. Century, you name it, Apollo Bank, any local bank, they're going to want to see, they're going to ask you for your 3 years tax returns. Since we are, for example, you walk into a lender today, we're in July. So he's going to ask you, give me an interim, give me your profit and loss for the 6 months. Because and again, that could help you, because if your sales, you did pretty good in 2022, but hey, you're really now have ramped up and sales are taking off now and you're selling more, your P&L can only help you. It shows a pattern that your sales are on track or improving. Obviously projections, especially a pro forma. Obviously, if you're a startup, they want to see a pro forma of, how is this business going to take off? How is the money going to come in and how is it going to go out? And also if you're doing a project, that's where a pro forma comes in. Business plan, when you're an established business that's been around for a number of years, the business plan takes on less of a role in the sense of a business plan. However, when you walk into a lender, if you've got a resume on you, hey, this is my industry, this is my background. One, it shows that your business, you know it, that you just didn't wake up last year and I want to be in the restaurant business. No, I've been a chef for 20 years. I decided to get my own location. I'm leasing it. This is my background. This is my certification. This is my product, my cuisine that I'm selling for this. I'm selling Cuban cuisine. So obviously this is the market that I'm going after. I'm situated in a certain location. That my market is there, I have market share. So a business plan helps to kind of educate the lender on your business. You know it, they don't know it. So they want to know who you are, where you came from, how the business came to be. And the business plan should always give them a trajectory of how the business started and how you got from A to B to C and how you got to them. How did the business grow? What helped you grow? And now you need capital. Because now you've got opportunities to capture more, let's say more of a market, more clients, or expand to a bigger location. So that's all part of a business plan. And obviously tax returns, that's the Bible on a traditional bank. They want to see last 3 years, they see a trend. They want to see how you did. Obviously they want to see that there's a growth pattern. The sales are going up, profits are going up, or at the very worst are steady, depending on your industry, that are steady. Personal financial statement to know, obviously, what is the source behind the business. The business is only as strong as the owner. And the owner obviously needs to have some assets, some sources in the event of a hiccup. It can't all rest on the business. And again, the resume ties into, if you don't have a business plan, a resume on yourself needs to be, call it not just a resume on you, a resume on the business, including you. And it outlines how you got from A to Z, from the day you started to today, how the business grew, what you accomplished, if you got any contracts or agreements, depending on, again, on your industry. If you're providing services, hey, I started, just doing, door to door, but now I've got 3 contracts. That's very valuable because that, to a lender, that means you've got a certain guaranteed revenue coming in from those 3. So that's what a lender looks for. They want to guarantee as much as they can with payment of the loan, and by having certain agreements from vendors or clients already, that's very, very helpful. And again, honestly, anybody involved in the business has to provide their financial and tax returns. A lender needs to know who they're banking with for many reasons. One, that's why they run your credit, to get your financials. to make sure that obviously, all the owners are involved are legitimate owners, and have legitimate backgrounds. Um, so obviously, anybody that's got a 20% or more in the company, will need to provide statements and tax returns. And again, some lenders, depending on the loan size and on the loan to value, depending on the product, um, they may not require the guarantee of a 20% owner, but they'll require the guarantee of the majority owners. They want to know who they're banking with and who the decision makers are, that are on the hook for the loan.
And then at the same time, like obviously one of the buzzwords has been developing the business plan. So and Jose brought it up, based on small snippets, but the business plan has multiple key components. The executive summary, who you are, how are you going to able to captivate the reader's attention, or specifying the key audience members based on your experience, your credibility, the summary of your history of your business, who are some of the key players and your personnel. What is your business model, based on those operating procedures? How is the industry? Is it growing? Is it decreasing? How are you in that business landscape, or the industry landscape? I'm sorry. What's your positioning? Is there a high volume? Is it high margins? Where are you in that evolving marketplace? At the same time, what are your competitors are doing? Are they doing the same thing that you're doing? Are you doing something different? They're doing something different. What is the overall understanding and analysis that your competition is doing? At the same time, you're able to do who are the key players in that industry, or who are the direct competitors within a 2-mile radius of the same services or products that you're providing, followed by the customers. Who are your primary and secondary target customers, or potential customers that you like to attract down the road? At the same time, once again, the products and services that you're offering or planning to offer down the road as a 3 to 5 year trajectory. What's your marketing plan? What are you doing? Are you going door to door? Is it social media campaigns? Is it billboards? Is it more the business development? Or perhaps it could be your own customers are your ambassadors or your marketers, marketing your business. In addition, the sales strategy. What are you doing for your sales? Is it a pricing model? Is it a seasonal prices? Is it annual? What are the different prices? But at the same time, the sales. What are you doing to be effective and generate those leads in terms of your prospective clients, so existing clients, and also how to retain them as well. The financial breakdown will go more in depth in the next few slides, and the optional appendices. It could be the respected contracts that you're getting, could be the capability statements, it could be any certifications of the business to showcase that that you know your stuff, and at the same time you showcase to the lenders that you are serious and credible, so you're able to obtain the necessary funds that you need for the business. So with the funding request, if you're seeking funds for your business, include these funding requirements in your business plan. What is the ask? And how do you intend to use these funds that you received? Is it for the request for capital expenditures, working capital, acquisitions, as if you're buying a new business, an existing business, or acquiring inventory or machinery? What is your strategic financial situation? Is it more debt repayment plans? Is it selling your business, buying outs, are you being acquired? So having all these requests, by having a good, strong strategic analysis, Jose will be able to guide you what are the next steps and also the alternatives as option A and option B, and perhaps option C as well.
Yeah, and something to keep in mind. Sometimes the answer is not the answer you want to hear. Sometimes the answer may be you need to wait, perhaps, keep generating for another 3 or 6 months. So it depends. I mean, sometimes you may not be ready yet.
Yeah.
You may not have, you could be too much of a fresh startup, and you've just got, you don't have enough under your belt as far as sales and profits, or you're selling but you're not making money.
Yeah.
So if, when it's a startup or a relatively new business, sometimes, you may need to continue bootstrapping for another 3 months, 6 months. Or it depends. If it's towards the end of the year, there's also certain times that are better times to apply for a loan than others. If you're you started in 2023 and you're in, let's say we're in August, September, you're looking for a loan. My advice would be, if it's a small amount loan, and your numbers may support it, we can probably maybe find you a source through a micro lender or a community organization as opposed to a bank. And I would tell you, once you finish your year and you file your tax returns, let's talk again, because now you've got a full year on tax returns. Lenders hate to discuss loans at the end of the year when you can't give them a tax return, and they won't know what you did until the beginning of the year.
Mhm.
So a lot of lenders at the end of the year, they'd rather say, look, bring me your tax return in 2024 and let me see what your actual results that you filed with are. Because a lot of times financial statements they're not final. You give them a P&L and even though it should be pretty accurate, a lot of times you make your bookkeeper can make adjustments. So they make the different, there's credit returns and what have you, depending on, again, on your business. So a lot of times there's better times to apply or to have your numbers. If we're in March, you got your tax return, you don't need a P&L because you just started pretty much. But we're in July. So right now, any lender, traditional lender is going to say, well, let me see your 2023 P&L numbers. Did you do great in 2022 and all of a sudden the business has dropped out and you're not selling anymore? So it's important to have a good handle on your numbers. And small business owners, you have to. It's part of the business, part of the deal. You can't, offshoot it and not know whether you're making money or not. You've
Yeah.
got to know.
And at the same time, have a full understanding of the industry, if it's cyclical or seasonal. Like, for example, like back to school uniforms.
Correct.
Like if I start my business, like now this can be my peak season as opposed in March. But then at the same time, the lenders would like to say have a comparison from last year, this time, for this year, based on those projections. So right there, you're able to carry that story and that narrative. If I'm looking for capital in April, but it's my slow season, that's what Jose is saying. Like if there's a dip, okay, now what's going on here? But if you're able to say that I'm using this to buy school uniform for back to school supplies or whatnot, then obviously there's gonna be a big peak right now, and right there you'll be more more credible and pretty much more
Yeah.
helpful for the lender.
As Jesus alluded to, that the story is important because it just makes the lender more knowledgeable and more comfortable regarding your specific industry and business. And if you're doing school supplies or school uniforms for the last 3 years and the trend keeps going up, and all of a sudden you're asking for a loan, hey, I need a loan because I've gotten certain opportunities to buy at a discount if I buy early. A lender can understand that, but you've gotten 3 years of tax returns showing him how the sales are going up and profits are there.
And
So that's a better story for a lender to understand.
and at the same time being open, transparent. Because a perfect example, look what happened during COVID. There was no need to buy school uniforms. Everyone and the children were at school at their houses, so there's no need to have uniforms. So right there, by having that story and that narrative, like obviously lenders will be, obviously life happens, so they'll be able, they're more lenient, but they just want to know what's your story. In terms of not being docked as you're being denied because of these particular reasons that were outside of your control. And then at the same time, providing these 3 financial statements, it is your, obviously what Jose has been talking about, your balance sheet, your cash flow projections, and the P&L losses. And then obviously explain, your forecast along how much money that you need and have, and when and how the business expects to make profit. That's the end goal for everyone. When are you going to make money? And at the same time, when is the bank going to be receiving the repayment process? And then obviously the good thing is that since today's presentation is being recorded and you'll be receiving today's presentation, I provided additional links in terms of how to create a balance sheet. The balance sheet, it is how to report your company's assets, the liabilities, and also any equity any shareholder has. In addition, with the cash flow projections is any money that's entering and leaving, or your business over a given period of time. It could be on a quarterly basis, weekly, monthly. Enables you to fully understand your existing financial obligations as well plan for the future. It could be anything. It could be just like in life in general with your card payment, with your credit card payments, school, your internet payments. So by having a full understanding of your own cash flows as your personal finances, it's the same exact issues in terms of the business. Understanding when do you have to do those existing financial obligations. It's paying your employees at this particular time frame, the insurances, the car payments if you have any vehicles, the supplies, paying your suppliers, or and also your vendors. So at the same time, that is a good opportunity for you to have a good understanding of your cash flow projections. And also, this link is really helpful, so you're able to plug and play. Last but not least, have a full understanding of your variable and fixed expenses. It is the fixed expenses, it is the consistent expenses that you have on a month-to-month basis. It is the salaries, it could be the insurances, it could be the rent or the lease payments of your brick and mortar location, your warehouse. The variable expenses, it could be the commissions or any additional inventory that you have to purchase, your COGS. So having a good understanding of your fixed and variable expenses will definitely help you out with your P&L projections on a month-to-month basis. And once again, it provides the overall insight of the cash flow of the company and shows, once again, where your money is coming from and how it is being used. And last but not least, this is the end goal. It's your break-even analysis. It shows when is the sales threshold that needs to be surpassed before the business becomes profitable. So this is a good key point in terms of when is your break-even analysis on a yearly basis. It could be after 3 years. This is when I finally broke even from all the initial bootstrap and startup costs. So having a good understanding as to when is your break-even analysis, that's when you're able to say, congratulations, my business is finally on the black. So Jose, do you have any comments, insights of break even, the P&Ls, cash flows, balance sheets?
Oh, again, just to reiterate what we spoke about. Again, when talking to a lender, again, there's many different lending sources out there. So don't necessarily get down if your credit is a bit low. If the business is selling and making money and is profitable, there's always a lender out there. It just depends on a lot of other factors, but there's lenders out there for different credit scores, for some that have been in business 3 months, 6 months to a year. There's a lot of lending sources beyond traditional banks and credit unions that are definitely worth a try. The cost may be a bit higher because obviously they're not traditional. But it depends, it's about seeing if whether the cost for this capital outweighs, the benefits outweighs the cost of it. If it allows you to buy more product and at the end make more money, sell more, gain more market, and have a better bottom line, then perhaps maybe the higher cost of financing makes sense. So the things to look at. And again, as Jesus mentioned, credit is important, but there's a lot of resources that Jesus can refer you to that can help you get that credit score up, which is a big factor in any lender discussion in general.
Yep. So I want to thank you all for attending today's webinar. So if there's any particular questions that you want Jose to go a little bit more in depth, by all means, I'll be more than happy to moderate on your behalf. Also, if you're interested to meet with our business consultants, want to meet with Jose based on some financial opportunities that are out there, by once again, so I encourage you to scan the QR code. Also, you could email us and I'll be more than happy to make that introduction for you. But once again, this is a recorded webinar. All participants will be receiving today's presentation and recording, but at the same time, there is a plethora of workshops that we have going on during the summer small business. So definitely I'm looking forward to seeing you at our next webinars as well. So yes, I'll put my email address in the chat. and I'll be more. I do apologize. I misspelled my own last name. Can you believe that? There we go. So I put my email address in the chat. So if you have any questions, concerns, anything that I can do to assist you to the best of my ability, don't hesitate. We're family. I am more than happy to assist you. And then if you want Jose's personal cell phone, just let me know. I'll be more than happy to do so. And because he'll definitely will make it happen to get you necessary funds. I'm just joking. I
Well,
want Jose
if you
to.
register, you have it. So
There you go. There you go. No, but let me see if there's any additional questions that I have here in the Q&A. Yeah, okay. I have a question here. Once again, is no cost business consulting. So all of our services confidential to you as well. Okay. Yeah, in order to meet with Jose, you have to register for a consultation. And like that, we'll be able to email you the necessary items of upcoming events and also my contact information, the link to register, also with the links for the YouTube channel as well. In regards of the chat, what type of items are you seeking to save on the chat? And I'll be more than happy to email it to you. You can email me what you want me to save on the chat, and I'll be more than happy to provide it for you. Okay. Yep, and I have a comment, Jose. Getting the answer that one's not comfortable is okay. It just helps you to get ready for when the time is available to apply. And just to be ready without the hitch. So it's not the time right now, but it's getting the next season for it to become bankable.
yeah, again, sometimes getting a loan, it's a learning process. It's a learning process. And I can tell you that money's a commodity. All lenders have the same money. It's all green. Now, but there are some lenders that are more aggressive than other lenders. So, sometimes it's not just about applying, but where to apply.
Yep.
There's certain lenders that are just, probably not the right ones that you may want to apply to, but you can apply to other ones that are probably a little more aggressive, a little more into the market in your service or in your loan size, or just depends. There's a lot of factors.
Yep. And then at the same time, how does our organization help to assist with credit scores? Once again, we could introduce you to branches and other partners that they have credit repair specialists to provide guidance on that side as well. So yeah,
It's also no cost.
yeah. So once again, I want to thank you all for attending today's webinar. But like I said, if there's any particular questions, concerns, anything that I could do to assist you, don't hesitate. Shoot me an email. I'm more than happy to assist you. So I want to thank you all for attending today's webinar. Jose, I want to thank you as well for you being part of today's webinar. And thank you all. And I'll be looking forward to seeing you at the next webinars. Thank you and have a good day.
Thank you all for attending.